Hello, knowledge seekers. In this episode of 20-Minute Books, we're diving into The Misbehavior of Markets by Benoit B. Mandelbrot and Richard L. H. Hudson. This enlightening read challenges the conventional financial theories taught in schools, which are often too simplified and dangerously misleading about the actual risks of the market. Mandelbrot, the pioneering mind behind fractal geometry, and Hudson, a seasoned science and technology journalist, unveil the shortcomings of traditional economic models and introduce the complex but revelatory world of fractal geometry as a tool to better understand market behaviors. Benoit B. Mandelbrot, celebrated as the inventor of fractal geometry, held the prestigious title of Sterling, professor of mathematical sciences at Yale University, and was a fellow emeritus at IBM's Thomas J. Watson Laboratory. His groundbreaking work earned him the Wolf Prize for Physics, among other accolades. Co-author Richard L. H. Hudson, formerly the managing editor at the Wall Street Journal. Europe continues to influence the scientific community as CEO and editor of Science Business Publishing. Limited The Misbehavior of Markets is a must-read for anyone engaged in financial endeavors, individuals considering entrusting their finances to others, or those captivated by the beauty and complexity of fractal images. Join us to unravel the intricate and often misunderstood dynamics of the markets through the lens of fractal mathematics. The Misbehavior of Markets, a fractal view of risk, ruin, and reward. Introduction. Why mainstream financial theories fall short in predicting market crashes. Mainstream financial models, with their precise and elegant equations, seem to offer a foolproof understanding of markets. Yet, time and again, the reality of financial markets shatters this illusion when unpredicted massive crashes occur. Let's take the 2008 financial crisis as a glaring example, a reminder that markets are unpredictable and do not always conform to the neatly laid out theories of economics textbooks. Traditional financial theories often treat market irregularities and volatilities as outliers or anomalies, somehow separate from the norm. This conventional viewpoint simplifies economic complexities to a fault, relying heavily on the assumption that all players in the market behave rationally and information is disseminated symmetrically, much like the predictably logical Lieutenant Commander Data from Star Trek. Enter fractal geometry, a mathematically robust framework that offers a more nuanced understanding of market behaviors. Rather than dismissing market anomalies, fractal geometry embraces the natural roughness in market movements. Just like the spirally, repeating patterns of a Romanesco broccoli, market trends too exhibit self-similar, intricate patterns that can tell us a lot about underlying economic conditions. Interestingly, some companies have already begun to recognize the limitations of traditional theories and have shifted towards approaches that consider more organic, fractal-based insights. One such company saw its net capital double after it decided to break away from mainstream financial predictions and adopted a strategy that aligned more closely with the unpredictable, fractal nature of markets. This move not only bolstered their financial standing but also highlighted the practical benefits of integrating alternative mathematical theories into economic practices. Through this exploration, we uncover how stepping beyond traditional economic methods and embracing the irregular but inherent patterns of financial markets can lead to more resilient and adaptive economic strategies, offering us a way forward in navigating the unpredictable world of finance. Part 1. Rethinking Rationality in Financial Decision-Making. Picture Lieutenant Commander Data from Star Trek, an epitome of logic and rationality, often puzzled by the whims of his human comrades. Mainstream financial theories propose that all investors act much like Data would, making decisions solely based on logic and self-interest to maximize utility. This idea, springing from the mid-19th century concept of Homo economicus, introduced by John Stuart Mill, suggests that we are all highly rational beings when it comes to financial decisions. According to mainstream schools of thought, such as the Chicago School of Economics, everyone is presumed to make the most logically sound choices, especially when they have adequate information. If the past month's data shows that a Venezuelan bank's stocks outperformed others, the rational investor should presumably see this as a straight path to profitability and invest accordingly. However, reality paints a quite different picture of our decision-making processes. Even in finance, humans are not purely rational. We often misinterpret vital information and miscalculate probabilities, a clear departure from the theoretical investor who always chooses the most logically profitable route. Consider a revealing experiment where participants had a choice between receiving a guaranteed $100 or flipping a coin to potentially win $200 or win nothing. Most chose the guaranteed cash. Yet when asked to either pay $100 or gamble with a coin toss, risking $200 for tails or zero for heads, many preferred to roll the dice. Technically, the intrinsic risk versus reward balance in both scenarios was identical, suggesting that a purely rational mind like Data's would make the same choice each time. Yet human participants responded differently, swayed by the framing of the situation rather than just cold, hard figures. This calls into question not only the rationality of investors, but also the very foundations of mainstream financial theories. Investors, like any people, can sometimes let emotions cloud their judgments or allow biases to influence their choices. They interpret gains and losses through a personal, often irrational lens, not just as figures on a spreadsheet. Thus, understanding financial markets requires more than just calculations and predictions based on presumed rational behavior. It requires an appreciation of human nature in all its unpredictable glory. Part 2. Unpacking the one-size-fits-all assumption in financial theories. Traditional financial theories often paint a homogenized picture of investors, grounded in beliefs from notable economic thinkers, like those from the University of Chicago's esteemed Chicago School. These theories operate under the assumption that all investors, when placed in similar financial contexts, will make identical choices aimed solely at maximizing monetary returns. This streamlined notion suggests a uniformity in investment goals and strategies. Everyone, according to this view, is playing the same financial game with the same end goal: to accrue as much wealth as possible, simply for its own sake. It also presumes a uniform approach to time horizons, the periods over which investments are evaluated, hypothesizing that every investor might, for instance, decide to hold on to stocks for exactly 5 years. However, the reality of investing behaviors is far more varied and complex. Investors have diverse objectives and operate within different timeframes that suit their personal or institutional goals. Some engage in high-frequency trading, capitalizing on daily market fluctuations, while others adopt a more conservative approach, holding stocks over decades, often aiming toward long-term goals like retirement funds. Moreover, the strategies employed can vary dramatically. Growth investors might chase stocks of rapidly expanding companies, often ready to pay premium prices or forego dividends in anticipation of future gains. On the other hand, value investors might prefer established, steady companies whose stocks are currently undervalued by the market. Clearly, the assumption that all investors behave identically underestimates the rich diversity of investment philosophies and practices. While simplification is a common scientific method to bring clarity to complex subjects, in the realm of finance, such oversimplifications can lead to misguided predictions about market behavior and potentially unfortunate investment outcomes. This misalignment between theoretical assumptions and practical realities prompts a critical reassessment of how financial behaviors are modeled and understood. Part 3. Understanding the surprising jumps in market prices. Common belief in orthodox financial theory holds to the idea that market prices move smoothly and gradually, adhering to a normal distribution pattern, akin to physical characteristics like human height, which tends to cluster around a mean value with few extreme deviations. For instance, in the United States, the majority of men's heights fall within a close range around the average height of 70 inches, with significantly taller or shorter heights being statistically uncommon. This analogy extends to financial markets in traditional theory, suggesting that most price movements are minor and extreme spikes or dips are rare. According to this view, stock prices and foreign exchange rates should follow predictable, smooth paths, changing incrementally over time. However, real-world data frequently contradict these theoretical expectations. Market prices often exhibit significant jumps, contradicting the idea of gradual change described by normal distribution. These jumps are not mere statistical anomalies. They are a recurrent feature of financial markets. One practical example illustrating this phenomenon is the behavior of currency brokers, who often round decimal values in quotes. For instance, if a currency's value increases from 4.2 to 4.8, brokers might round this to a jump from 4 to 5, effectively exaggerating the perceived change. Moreover, substantial price fluctuations can result from order imbalances. These occur when there is a significant mismatch between buy and sell orders, often triggered by impactful news or events. For instance, if the Food and Drug Administration approves a new, potentially lucrative drug, it could lead to a sudden surge in buying activity for stocks in the relevant pharmaceutical company, sharply driving up prices. These insights into price behavior challenge the conventional wisdom of orthodox financial theories and highlight the need for models that accommodate the actual unpredictability and sudden movements observed in market prices. Understanding these dynamics is crucial for investors and economists alike, as it affects both market strategy and economic theory. Part 4. Challenging the assumption of independent price changes in orthodox economics. In the year 1900, Sorbonne University's academic circles were less than enthusiastic when Louis Bachelier chose to analyze the speculative dynamics at the Paris Stock Exchange for his doctoral thesis. A preference for more abstract or classical mathematical topics existed, but Bachelier's work would later form a cornerstone for modern financial theory, influencing it profoundly some 7 decades afterward. Bachelier's pioneering model posited that price movements in the market occur randomly and independently of each other. To illustrate, consider a scenario where you're observing a particular stock that has risen for 3 consecutive quarters. Bachelier's model would suggest that this past performance offers no reliable guidance for future movements, similar to predicting the next outcome in a series of coin tosses where previous results have no bearing on future tosses. The chance of flipping heads remains stubbornly at 50% each time. This foundational idea in orthodox financial thinking stresses that there should logically be no discernible patterns in price movements akin to the randomness of tossing a coin. However, empirical evidence gathered over years suggests a different narrative. Economist Campbell Harvey conducted studies which indicated that, contrary to Bachelier's theory, price changes are not entirely independent. He discovered that if a stock's price has increased over the past month, it's more likely to continue rising. This indicates that there are indeed discernible trends in price movements, potentially driven by factors like significant news announcements, which can cause investors to rush to buy or sell, thereby influencing further price changes. Moreover, Harvey's research provided insights into longer-term trends, noting that stocks, which performed strongly over 5 years, often showed a tendency to decline in the subsequent 5 years. This suggests a kind of cyclicality or correction phase that contradicts the notion of randomness and independence posited by traditional models. These observations invite a re-evaluation of mainstream financial theories, demonstrating that price movements are influenced by a complex array of interdependent factors rather than existing as isolated events. This realization opens up a broader discussion on the need for more nuanced and realistic models that better reflect the dynamics of financial markets. Part 5. Embracing Complexity: The Necessity of Fractal Tools for Financial Markets. Traditionally, scientists and economists have considered irregularities in data as anomalies, mere deviations from an ideal or expected pattern, such as the smooth bell curve commonly used to describe normalized price movements in markets. Extreme fluctuations, therefore, were treated as statistical outliers, not indicative of normal behavior. However, a closer look at the natural world and market dynamics reveals that many of these so-called anomalies are not exceptions, but are fundamental aspects of rough or complex systems. These systems do not conform to simple smooth patterns, but exhibit behavior that is inherently turbulent and unpredictable. Consider the example of wind in a tunnel. As wind speed increases, airflows transition between smooth passages and chaotic turbulence, marked by sudden gusts and intricate swirls. This type of behavior mirrors the turbulent flows observed in financial markets, where stock prices can experience sudden and severe changes, contrary to the gradual shifts predicted by mainstream economic models. These traditional financial theories often struggle to accurately capture the real essence of market dynamics because they are designed for smoothness, not for the roughness encountered in practice. This mismatch highlights the need for analytical tools that can handle the inherent complexity of financial markets. Fractal geometry offers a promising avenue for exploring such complex systems, originating from the Latin word fractus, meaning broken. Fractals describe structures that are irregular and fragmented at all scales. A classic example of a fractal in nature is Romanesco broccoli, which exhibits a self-similar pattern. The vegetable is composed of smaller, broccoli-like structures, which in turn consist of even tinier versions of themselves. This fractal pattern is not just a feature of quirky vegetables, but is also a fundamental characteristic of many natural phenomena, including the turbulence seen in both wind patterns and stock market prices. By applying fractal mathematics to financial markets, economists and analysts can better understand and predict the rough patterns of price movements that traditional models fail to address. Embracing the fractal nature of markets could significantly advance our understanding and management of financial dynamics, allowing for more accurate predictions and more robust financial strategies. This shift in approach highlights the broader lesson that complex problems require equally sophisticated tools, specifically designed to grasp their inherent roughness. Part 6. Decoding the Fractal Essence of Market Dynamics. Imagine this. It's 1961, and Harvard professor Hudson is poring over a century's worth of price records from the New York Cotton Exchange, striving to make sense of the erratic data using Bachelier's model. Despite his efforts, the fit is just not right. The cotton market exhibits a rough and turbulent pattern, starkly contrasting the smoothness expected in traditional financial models. The data, characterized by frequent and significant price surges and falls, challenges the confines of normal distribution consistently. The inconsistencies do not stop there. Not only do the price leaps vary wildly, but the average magnitude of these changes also fluctuates dramatically from year to year. Some years witness stable prices, while others see extreme volatility. This irregularity left traditional models like Bachelier's struggling for relevance, unable to accurately capture or predict the market's behavior. Enter fractal geometry, a potent mathematical tool capable of navigating this complexity. Fractals, with their inherent roughness and self-similar patterns, like the endlessly repeating florets of Romanesco broccoli, provide a more suitable framework for understanding such unpredictable data. In the context of financial markets, fractal geometry is closely linked with the concept of the power law, a statistical tool used across various disciplines, from estimating earthquake impacts to analyzing income inequality. This law explains phenomena that do not conform to normal distribution, but instead demonstrate scale invariance. much like the self-similarity of fractals. Scale invariance means that no matter how closely you zoom in on a segment of the data, it resembles the overall picture. To put this into perspective, consider plotting two log-log graphs of cotton price movements, one charting a week and another spanning a decade. Surprisingly, both would exhibit strikingly similar patterns, regardless of the time frame. This fractal characteristic of market dynamics, mirroring the irregular yet patterned complexity seen in natural phenomena, offers a profound insight. Markets are not chaotic jumbles, but intricate systems governed by rules that transcend traditional financial models. Understanding these patterns through fractal geometry not only challenges established economic theories, but also opens up new avenues for predicting and navigating market turbulence. Thus, recognizing the market as a fractal phenomenon equips analysts and investors with a more accurate and robust framework for understanding financial uncertainties. Part 7. Reconceptualizing time to decode market behaviors. Have you ever noticed how time seems to drag endlessly during a dull lecture, yet flies by during an exhilarating concert? This subjective experience of time varies significantly from the constant tick of a clock, illustrating that our perception of time can be flexible and context-dependent. This concept of variable time perception also applies effectively to financial markets. Traditional market analysis, which typically relies on standardized time units like days, months, or years, often fails to capture the dynamic nature of market behaviors. Just as personal experiences can make an hour feel like a minute or vice versa, market activities can make certain periods more significant than others. In markets, there are days filled with high volatility and big price changes, times when a lot of information is generated. On other days, the markets might be quiet, with very little information produced. Thus, relying solely on chronological time, like the hours on a clock, to analyze market patterns can be misleading. Enter the concept of trading time. This innovative approach suggests that time intervals in market analysis should not be defined by the clock, but by the amount of information or change that occurs. In this context, information refers to instances of price movements, regardless of their size. For instance, we might define a time interval as 40 units of information. This could be 40 significant price movements, irrespective of whether they occur within a single day or are spread out over a week. This approach allows analysts to scale their observations dynamically, tuning into the market's rhythm more accurately than if they were confined by conventional time measures. What makes this approach particularly powerful is its roots in fractal analysis, where the structures remain consistent across different scales. Whether analyzing data over hours, weeks, or years, the relative proportions of price changes remain consistent, even if their magnitudes differ. By adopting trading time, financial analysts gain the flexibility to account for the market's inherent roughness, viewing it through a lens that aligns more closely with its natural dynamics than the arbitrary segments marked by a clock. This not only provides a clearer understanding of market behavior, but also enhances the accuracy of predictive modeling in finance. Thus, like adjusting our perception to meet the context of our experiences, we redefine time to better grasp the complexities of market movements. Part 8. Fractal Geometry, a rising tool in modern economic analysis. As we delve into today's sophisticated financial landscapes, it becomes evident that traditional views such as Bechelier's model and the ideation of Homo economicus don't fully encompass the dynamic nature of markets. Despite the absence of a comprehensive economic theory firmly rooted in fractal mathematics, some forward-thinking entities are already harnessing its potential. Particularly, Oanda, a prominent financial provider known for its online currency conversion platform and foreign exchange services, has adopted fractal geometry to analyze its wealth of tick-by-tick data. That is, the constantly updating price changes that occur in real time. This application offers a compelling case study into the effectiveness of fractal analysis in providing nuanced and actionable market insights. In addition to Oanda, The concept of multifractal analysis, an advanced branch of fractal geometry, is gaining traction. This form of analysis is particularly adept at managing market heterogeneity, which includes accounting for the varying behaviors of different types of investors and the irregular distribution of price changes. These capabilities make multifractal analysis an invaluable tool for developing innovative trading strategies. The impact of fractal strategies is notable. For instance, Oanda reported a more than doubled net capital in the year 2003, illustrating the tangible benefits of implementing these advanced mathematical techniques. Similarly, France's largest hedge fund, Capital Fund Management, has successfully integrated multifractal analysis into its operations. While their strategy isn't solely based on fractal models, they utilize multifractal analysis for critical functions like risk control and option pricing. Moreover, when it comes to planning trades and portfolios, they leverage mathematical techniques derived from fractal geometry. This approach notably stood the test during 2002's market downturn, where despite a general market fall by a third, Capital Fund Management's largest fund posted substantial gains of 28.1%. These instances underscore the increasingly recognized role of fractal geometry in contemporary economics. The promising results achieved through fractal-based strategies suggest a paradigm shift might be underway in economic theory, paving the way for more robust, fractal-inspired models that could revolutionize our understanding of market dynamics. The next logical step is the cultivation of these preliminary models into a comprehensive, fractal-based economic theory that could offer deeper insights and more effective management tools for the intricate world of finance. Final summary. The central takeaway from this exploration is a critical evaluation of traditional financial theories which have long dominated the field. These conventional models, structured around a rigid understanding of market behaviors, significantly underplay the actual risks involved in financial markets. Traditional financial models, often rooted in assumptions of normal distributions and rational uniform behaviors by investors, fail to capture the complexity and unpredictability inherent in real-world markets. The 2008 financial crisis, among others, has exposed these shortcomings, highlighting the urgent need for tools that can navigate and manage the complexities of market dynamics more effectively. In response to these challenges, innovative mathematical tools such as fractal geometry have started to gain traction. The application of fractal models offers a more nuanced perspective that accommodates the irregular and volatile nature of market changes. Firms like Oanda and Capital Fund Management have showcased the practical benefits of embracing such complex mathematical strategies, reporting improved financial outcomes through enhanced risk management and strategic trading practices. As we move forward, the fusion of these advanced mathematical tools into financial analysis not only promises a deeper understanding of market behaviors, but also heralds a new era of more resilient and adaptive economic strategies. This shift towards embracing complexity and moving away from overly simplistic and rigid models could pave the way for a more robust financial landscape, better equipped to withstand the challenges and capitalize on the opportunities of the dynamic global market. Thank you for joining me today on this journey of learning and discovery as we explored the insights of another thought-provoking book in our growing library of knowledge. If you've enjoyed our time together, please take a moment to follow our podcast, give us a 5-star rating, and share 20-minute books with other knowledge seekers. Your support truly means a lot. Don't forget to join me again in the next episode, where we will delve into another enriching book. Until then, happy reading and happy listening.